we log into your investment portfolio, if the balance has gone up, we don't have to be excited about that because it doesn't mean anything. Same thing, if your balance has gone down, doesn't mean anything unless you choose to take action, unless you choose to sell at a loss and make that a realized loss, or sell at a gain and earn that profit.
Young Canadians are some of the most avid investors around.
3/4 of Gen Z here own at least one investment, according to data from the CFA Institute and Finra Foundation. In China, the US, and the UK, it's closer to half.
But the data shows that young Canadians might be risky investors as well. The most popular investment they're starting with? Cryptocurrency.
Not exactly the most stable, tried and true asset.
So, are new investors taking on too much risk? Or is that just what you need to do today in order to make it in the face of today's financial challenges? I'm Betha Moorcraft.
And I'm Kadeem Layler.
And this is the Half Bank Podcast, brought to you by Money.ca.
To help us get more comfortable with all this risky business, we'll be speaking to a Vancouver-based financial counselor who built a net worth of $200,000 by the age of 28.
Parween Mander. She's an accredited financial counselor and certified trauma of money facilitator, as well as the founder of The Wealthy Wolf. Inspired by her own South Asian upbringing, she now focuses on helping women of colour from immigrant backgrounds achieve greater financial freedom. Parween, welcome.
Thank you so much for having me, Bethan and Kadeem. Excited to be here.
Oh, we're very happy to have you on the show. So, Parween, you've spoken publicly about almost losing your home when you were younger and the fear that instilled in you. You say on your website that you were frugal and you saved the majority of your money and really hated to part with it. How did you go from someone who was afraid to spend their money to becoming a confident and successful young investor?
Ooh, it's a good question. I would say it took a lot of psychological work to unpack what was money trauma that occurred during my upbringing and understanding the true impact of the scarcity mindset on my money behavior. So things like that frugality with parting with my money. So I couldn't really even enjoy a Starbucks coffee, right, without feeling guilty. And so really understanding, I guess, the impact and empathizing with myself that I was overly exposed to adult financial matters at a very young age as the eldest daughter in an immigrant household, how that, really played out into those money behaviors. In terms of the strategy that I used to really start to let myself enjoy my money was having a separate spending account. And so every time I was paid for my 9 to 5, put in a few $100s into the separate spending account. And then I was like, okay, Parween, your savings goals, money went that way. Your investment goals, your money went that way. So this is money that you can spend now guilt-free. And it was only when I started to implement that system that I started to loosen, the reins a little bit and starting to feel comfortable of like, you know what, I can enjoy my money. I don't need to be stuck in that anxiety and frugality mindset.
Perfect. I mean, you touched on just now also being the oldest daughter in an Indian household. Yes, I'm wondering in terms of investing, were there specific hurdles or patterns you kind of fell into due to that immigrant background and ones that you see perhaps clients go through as well?
Yeah, absolutely. I think this idea as a daughter of immigrants that I always witnessed my parents work hard for their money. It was always this idea that you have to trade your time for money. And with investing, it's very much the opposite. It's you invest your money and then you don't actually have to do anything actively. Like it grows for you. And so that was a concept that I think I struggled with to understand, which is that, well, I thought in order to gain wealth, you had to work really hard for it and, work long hours. Another thing too is that specifically within the South Asian community, investing in the stock market doesn't really necessarily exist, I would say. Our elders, people in our community, that's not what they did. Instead, it was more so things like real estate or gold, right? Which are both sort of really hot commodities, but also really expensive to enter, especially as a now millennial or being part of this generation. And so even just having the capital or the startup money to get a real estate investment, any of these things is really difficult. But what I see with a lot of my clients is that they're so heavily focused on saving for that down payment, trying to get that first quote unquote investment, right? Without truly realizing the cost of home ownership, and the idea of investing in the stock market isn't as appealing.
That's really interesting. I like what you said about kind of learning to enjoy your money and splitting it between, two accounts, one that you put towards saving, living expenses, etc., and another that you use to invest. Just wondering, do you remember, once you made that decision, the first thing that you invested in or the first investment that you made?
Yeah, I had started with a robo-advisor called Simple, and I'm not promoting them by any means, but they were just the first ones that I started with. And so I opened an account with them. I opened a TFSA, which is a tax-free savings account, which is a tax-sheltered account. which if you want to start investing, your first step is to open a tax sheltered account, whether that's the TFSA or the RRSP, the Registered Retirement Savings Plan. And so I opened up a TFSA, and then essentially I picked my risk tolerance. And so typically with robo advisors, they already have pre-built portfolios of investments that you can invest into, which makes it very, very easy as a young person to get started with investing, because I don't have to pick what I'm investing in. So I was able to pick a very diversified stock portfolios. I think I chose the balanced portfolio, and that's where I started my investing journey with.
So I was wondering, you talk about starting places. Well, for Gen Z, about 35% of them, most common investment that they have, 35% of Gen Z. So how do you feel about crypto as a starting place?
Oh, I don't love it. I don't love it. I think the volatility with crypto makes it a really difficult investment to begin with. I think in the age of social media and the age of the sensationalism around crypto and the crypto quote unquote boom has sort of led to this idea that it's the way to go in order to grow your money the fastest. But when it comes to investing for a long term, it's actually supposed to be quite boring, and it's also supposed to be, sort of the slow wave, right? Your investments will go up, they'll come back down, they'll go back up, they'll come back down. That is the natural cycle of the stock market, and it has been for the past 100 years, right? And so I think understanding that true investing, strategic investing is quite boring, right? But it's also strategic and the safest for you in the long run versus crypto, which there is no regulation of what could happen in that area, right? People have lost lots of money, or they're holding on to what could be remaining balances in that account when they could have just earned more returns in the stock market. And it's actually something I do see with my clients as well. I'll be reviewing their finances, they'll have debt, and then they'll have money in crypto. There'll be no money in savings, there'll be no money in a TFSA or an RSP. And so again, it's just where that information come from for them. Oh, so and so said I was supposed to do it, or this person on social media said I was supposed to do it, right? So they just fell into the hype, and I think that's just very dangerous.
So there is some info from a CFA FINRA study shows about 56% of Gen Z investors in Canada, basically the lack of knowledge is their main barrier to diving in. So, with all that bad information around, it's easy to get sucked into that. Like, where do you recommend novice investors actually get started?
Yeah, so you'll be starting with picking your tax sheltered account, the TFSA or the RRSP. I then always recommend to my clients who are just starting with investing to start with a robo advisor. And so, depending on where you're based, whether it's the US or Canada, there are now multiple robo advisors available. So I would start there because, again, robo advisors take the guesswork out of investing, and on top of that, they are a cheaper way for us to invest. I think we also need to take a step back here, which is people, when they think about investing, think they have to go to their bank, invest in mutual funds as the way to start investing, but that can be, again, a expensive form to start investing because of something called MER, which is your management expense ratio. And so I'm saying these terms, and it may sound a little bit overwhelming, but it is also some important information to know before you dive headfirst into maybe walking into your neighborhood bank branch and giving them your hard-earned money, right? And so with a robo-advisor, it's actually a cheaper alternative in terms of that MER. It's easy to get started. You will pick your risk tolerance. And so risk tolerance really refers to how much you can stomach personally in terms of riding the waves of the stock market. And so I want to reiterate that the stock market going up and down is a normal cycle and has been for the past 100 years. I think a lot of fears that young investors have is, well, I lose my money if I invest in the stock market, right? And so something I really preach here is the idea of neutrality, which is when you log into your investment portfolio, if the balance has gone up, we don't have to be excited about that because it doesn't mean anything. Same thing, if your balance has gone down, doesn't mean anything unless you choose to take action, unless you choose to sell at a loss and make that a realized loss, or sell at a gain and earn that profit. But remember, investing is for the long term, right? And so we want to leave that money alone. So risk tolerance, again, is just how much you can stomach in terms of riding up the waves of the stock market. You can go conservative, you can go with a balanced approach, or you can go aggressive. Okay. And so you just pick one of your portfolios, and then you just set up automatic, payments into that account each month to be deducted, and you're investing in the stock market.
And so you mentioned a risk tolerance. So how should young Canadians determine what theirs is?
I think the first thing is understanding what you're investing for, and if you have specific goals for it, and what the timeline for those goals are. So things like retirement are ideally, 30, 40 years away, right? And so you have a lot of time to ride out the natural waves of the stock market. And so you can afford to be more aggressive with that. And you ideally should be, as a young investor, be able to have a higher risk tolerance in that. But once again, I understand that there may be some factors there that prevent you from being maybe comfortable with that risk. So maybe it's stuff from your upbringing, maybe it's certain money scripts that you hold. And so again, wherever you are comfortable to get started, just get started. If it's goals that are like you want to save for a down payment or something that's maybe within a 3 to 5 year range, that's money that I would say you typically don't want to invest in the stock market for the sole reason that it's really unpredictable where the stock market may be in that time frame. So if you were to go pull that money out for a down payment, maybe the market is down. And so again, you are selling at that loss. And so when it comes to investing in money and any money they're putting into investing, it should be 10 plus years away, or sorry, over 5 years away, so that you have time to sort of ride out any ways with the stock market.
So, Parween, for your early experiences, you've mentioned your saving method and so forth. But then, how did you go about really dictating what your risk tolerance was?
Yeah, I think when I first started investing, I was really aware that it was a brand new territory for me. And so even though intellectually I knew, hey, as a young investor, I should be really aggressive with the portfolio or types of funds that I own, I couldn't stomach that. And so I just picked a balanced portfolio to determine, and that sort of got me, I guess, my feet wet in the realm of investing. I think another thing I want to stress here, which was a lot of my early 20s and mid 20s, was saving for life events such as my wedding or a down payment. And so, because I knew I had those immediate goals coming up, that was money that I kept out of the stock market. That was money that I did not invest because I knew I needed to have access to that right away. And so that also made me feel really comfortable with investing because whatever I was putting aside into my TFSA, because that's what I started with, it was money that I actually didn't need access to.
So, although we have been advocating for kind of slow and steady, I'm wondering, do you have any regrets, Parveen, about not being more aggressive with some of your investments when you were younger?
That's a good question. I think yes, when I look at the value of my portfolio, I'd have been like, well, had it been more aggressive, this probably would have been, a higher balance today. And just from a pure numerical standpoint, that would have, benefited me. However, when I think about where I was emotionally and mentally in my 20s and just dealing with the idea of investing, getting comfortable with it, I think that was the right call for me at that time. So I wouldn't say I necessarily have any regrets. I think more so maybe what it did was really solidify the idea that, what, I've already been investing 4 or 5 years now, and I'm going to continue with the same long term strategy. I can afford to be more aggressive, and it actually makes me more excited too. I don't think I have as much fear when it comes to investing. I'm very, very comfortable taking on a higher risk tolerance because I've spent so much time in the market and educating myself because I got started a lot earlier so that I got a lot more comfortable and built that confidence for myself.
Have you found that some of your clients come at you with some of these like regrets in terms of, I didn't start off with enough risk or I started off too aggressively? Kind of, what do you hear from clients?
It's a very much a mixed bag. I hear a lot of, well, I did invest, but then I lost my money and then I just took it all out and I haven't been back in. And so again, that education piece of understanding and how the stock market actually works, and so that we can actually just stay consistently in the stock market. I think another thing too is that a lot of my clients fell into, well, I need to individually pick stock. So I hold Apple, or one of my clients, she lost about half of her portfolio because she invested in this one stock that she thought would do really well. And so I think it's understanding the different risk tolerances, but also the different methods of investing, and recognizing that we don't have to pick one stock. We don't have to pick a couple stocks. You don't have to actually do that actively, right? Strategic investing means you're investing in thousands of companies at once through things like robo advisors that are already established for you. So I think when it comes to risk tolerance, as long as you're going about it in a way where it's a pooled amount of investments, there's a lot of diversification, right? That's a different conversation, I think, when it comes to risk. Then it's like, yeah, you can probably afford to go from conservative to balance or balance to aggressive. But if you're starting that someone that has, maybe not great experiences with investing in the stock market because your education, the knowledge piece wasn't there, I do see mistakes with just taking on too much risk, right? And putting all their eggs basically in one basket.
So, in terms of speaking of too much risk, with some of the financial challenges young people face today, there's debt. So it could be student debt, and then so forth. Could be possibly being a bit house poor. There's dealing with inflation, maybe stagnant wages. Basically, does all of that in your mind make accepting a bit more risk kind of more necessary nowadays?
I think when we think about that question from the angle of, okay, the money that you're investing is separated from your day to day living expenses, you're not reliant on it, right? I think that's the key difference here. Then yes, there is an argument that the economic times we've been in today has that push to be like, well, you can afford to be more aggressive because inflation is just going up higher and higher, or it's staying at these rates, and it's making it more difficult to earn a living and all these things. So I would say that argument does exist. I think that's the real power of investing, right? Which is that your money grows and outpaces inflation versus you just trying to save every dollar and then just ultimately lose purchasing power in time. So there is an argument to be made, but I think given where everyone's at with their finances today, again, if you are living paycheck to paycheck, maybe you can't even put money into investing. I want to stress that that is okay. That is okay to meet you where you are, right? But if you are someone that is able to start investing now, again, the argument can be made that maybe we can go a little bit more aggressive, right? If that money is not needed within a certain time frame and you're not using it as an emergency fund, all those things.
Once a young person has kind of figured all of that out, they've nailed down their risk tolerance, and they know their financial goals. How should they then going about kind of determining what kinds of assets they should invest in to achieve their goals?
Yeah, I think this is where, again, working with a robo advisor takes a lot of the guesswork out, which is that you don't necessarily have to pick. And I think that's what keeps a lot of people from entering the stock market, which is, so, well, how am I supposed to pick like the best investments and the best stocks and the best sectors and the best countries? Like, luckily for everyone is that that's already done for you when you go with a robot advisor route. But if you are someone that maybe wants to learn a little bit more about, hey, what exactly am I investing in? How do I maybe determine the differences between a balanced portfolio and a aggressive portfolio? Then you want to look at what's called the fact sheet for that fund, and that way you can see a breakdown of the different sectors. Maybe it's 20% financials, 10% maybe it's Canadian or wherever it may be. You want to look at the breakdown of the sectors, the countries. And the main thing with investing is that you just want to be diversified. I think maybe a lot of people have heard this phrase that you don't want to put all your eggs in one basket. And so diversification means that you are owning, thousands of companies in a wide range of sectors or countries to spread out that risk. And so that's the one way you can start to do that, is I was just looking at the fact sheet or the specific breakdown of maybe what some of these funds or robo advisors are offering.
That's great advice. Thank you. Hold on to that thought, everybody. We're just going to take a very quick break to hear a message from our sponsors.
Money.ca is proud to bring you this episode of Half Banked. You've got important money questions. That's why you're listening to this podcast. From buying a home to investing for your retirement, Money.ca is the place to get all the info you need to live a richer life. What's an ETF anyway? And how do I choose the right ones to invest in? Should I go with a variable or fixed rate mortgage right now? Our team invests hours researching and interviewing leading experts to bring you the best guides and latest news that matters to you and your finances. For every stage of your financial journey, Money.ca is here to help you get ahead.
Especially in the last few years, kind of since the pandemic, there's been a lot of scary headlines.
Mm.
Talks about recession, inflation, rising interest rates, a lot of things that people may not understand completely, number one, and number two, they look at it and think, oh, that's scary.
Yeah.
I'm just gonna park my money in the bank and put it in my savings account and then I'm done. Have you noticed changes in terms of how your clients are thinking about investing with all of these kind of big themes in the background?
Yeah, I think one thing that kept coming up for a lot of my clients last year was that, hey, a recession is coming, so I'm just going to wait until we hit the bottom,
Mm-hmm.
right? And this is a mistake that a lot of people make, which is that you think you can time the market. Like, oh, this is when it's going to drop, this is when it's going to go back up. But I think as investors, we need to release some of that control that we think we're going to have over the stock market because it's completely unpredictable. And so some of my clients actually missed out on grabbing securities at a lower price point because they just kept holding on and waiting for what this sensationalized recession or these headlines that kept saying certain things. And so as an investor, you actually really want to tune out that noise to the best of your ability, and you want to take part in something called dollar cost averaging. So if you are someone who will start investing and you have a certain amount that you put aside each month, just the fact that you're able to put that aside every 2 weeks or every month on some sort of consistent basis, you're doing something called dollar cost averaging. And so 1 month of the stock market might be at a bit of a high, and so you're grabbing those securities at a higher price point. But a few months later, maybe it's a bit lower, and so you're buying these securities at an average point. Okay, and so I think this idea of when you're just investing consistently, there's no need for you to time the market. And you also don't have to listen to all the sensationalized noise that news and all those casters make.
It also touches on another interesting question: is how do you decide the right amount to save versus the right amount to invest?
Yes, I think so. As a money coach, something that's really close to my heart, which is cash flow management. And what I mean by that is really budgeting, right? And so I think a mistake I'll see with a lot of my clients is that they overshoot what they can realistically put aside into financial goals like savings or investings or debt repayment, because they're so gung ho to like just get those things done, but they're not adequately putting money aside for living expenses, right? Or acknowledging that, there are certain things that they want to buy themselves month over month. So when it comes to determining how much you need to put into those goals, I always say first start with doing a financial audit. So download your past 3 months of bank or credit card statements and start to highlight in different categories. Okay, like how much do you typically spend on eating out, on personal care, on shopping, on all these things. Get those numbers, and for the most part, it will be shocking while you go through that exercise. But the point of that exercise is that it tells you just realistically how much it costs for you to live like your life, right? And again, an opportunity for you to start maybe reducing some spending in some areas. But we need those numbers to back that first, and then you can start making a budget. Okay. And then when you have that money adequately set aside for those expenses and day to day living expenses, whatever is remaining is a realistic amount that you could put aside into savings or investing. Now, if you have more immediate savings goals, and this all comes down to timeline and priorities in terms of, well, do you put more into investing? Do you put more into savings? It depends, right? So it depends on who you are, what your goals are, what's going on in your life, right? If it is a down payment, if it is a wedding, maybe it's travel, maybe it's all these things that you want to prioritize first. Okay, maybe we're putting a little bit more into savings, and maybe we're starting with just $50 a month into your TFSA or your investment account, right? The point is that there's no wrong way to do this as long as the amounts are realistic. And on top of that, with investing, as long as you are investing. So as an investor, the phrase always gets stated a lot, which is it's time in the market versus timing the market, or timing the market over how much you're investing. So just investing any amount, if you can get that in your 20s, early 30s, will set you up for, that money to grow over time.
Do you feel like Canadians are taking on enough risk, too much risk, kind of these young Canadians at the start of their journeys?
I think that's a good question. I think I don't want to generalize because obviously I don't have any studies available to me, but I think based on where my clients are, I think most of my clients are very hesitant to invest. And because of that, they pick like the conservative risk tolerance or the balanced risk tolerance. And that's where they're comfortable with. I think another thing I need to mention here is that most of my clients are women from immigrant upbringings. And so again, there is sort of an embedded aversion to risk because of that. And so a lot of my clients, they need a little bit more time with getting comfortable with the idea of investing, getting comfortable with the idea of like, hey, if I put this money away, it might lose value, quote unquote. And so I think because of that, my main thing is I just want my clients to start investing. And we've talked about through kind of logistics and the education of, hey, well, how the stock market actually works. In time, maybe now that you've gotten comfortable, you can maybe switch things to a little bit more of an aggressive portfolio. I think Canadians or millennials do have the opportunity to take on more risk, but with a big caveat of as long as the money that's for investing is not needed for any other aspect of your financial life, right? It's not money that you're banking on as an emergency fund. It's not money that you're using to pay off debt, right? It's money that you can just keep to the side for the purpose of it growing.
Yeah. It's interesting what you say about young women in my late 20s and a lot of my peers, female peers, young professionals in Toronto. They all say the same thing. We want to invest our money. I've got all this stuff in savings, but I don't know where to start. And I don't really know what to do. That seems to be the general message. So I said, listen to Heart Banked. No, but it's definitely a very common theme, and I've been sort of party to that too. Do you have any thoughts on why maybe there is some sort of gender difference there between kind of young men and young women at this age? Because I think my male friends are probably a bit further along this journey.
Yeah. I think it comes down to the idea of, well, how money in general has been gendered in our society, right? Which is that typically it's like the men are the breadwinner, the men control the finances, they know what's going on with the numbers, and women are supposed to take a back seat, and they're not as capable to manage their finances. So I think when we have all those embedded narratives, right, it's going to show up when it comes to like the world of investing as well. And I think another thing too is also understanding that the world of investing, I think when we see the representation of maybe who's working on the stock exchanges, all these things, or these hedge funds, it's typically men, right? And so it doesn't really feel like a welcoming space as women, right? And I think there's also this fear of like, don't want to make a mistake, don't want to be stupid, or any of these things, and that all those things prevent women from investing. Now, what's interesting is that a study has been done to show that women are actually better investors over time than men because they have more patience and they're not as quick to make self investments or take any rash decisions. So I think that's also something interesting that I found through that study. But I think it's also this idea that women are more than capable of starting to invest. You don't need to get the help or the advice of a male in order to do so. But again, it starts with obviously taking that first step.
So confidence we touched on is a huge issue, and there is a 2023 study by cooperators that shows that 26% of Gen Z as a whole, or 18 to 44-year-olds, are unsure. Basically, they're not confident in their ability to choose investments that will actually make money. So then, might be dealing with decision paralysis if you're trying to start out. That lack of confidence. How do you go about building that confidence?
You go about building that confidence by just starting with investing. When I started my investing journey in my early 20s, I had learned just enough, right? I was like, okay, this is like the platform. This is what it means to invest. This is what a risk tolerance and diversification means. Hey, a robo advisor is someone that already picks everything for me. There's thousands of companies in this one thing I'm about to buy. And so that was enough for me to just get started with investing. And I think that's, again, that analysis paralysis. I think we're in an age now where there are very millennial friendly investing solutions like the robo advisors. That's a 10 to 15 years that those have really sort of popped up and become a formidable investing vehicle for a lot of people. But I think there's just a lot of fear still of like, what's a robo advisor? Should I not just go to my bank and just open a mutual fund, right? But people hear that that's really expensive, so you just get stuck, and you can be stuck there forever, right? Which is like, well, I'll do it next month, or I'll look into that thing next month. You just need enough information to get started. And as a young investor, I think it's also the expectation that you might make mistakes, right? You might sell investments at a loss. You might get a little bit scared. But like I said, it's time in the market that's most important as a young investor. So if you can just begin $50 a month, $100 a month, right? Just get your feet wet. It's really, really important as a way to build that confidence and evidence for yourself that, you can do this.
So, Parween, thank you very much for your time. Much appreciated. I think this is a great look at the mentality of investing, kind of the sense of looking inward, not outward, your reasons, goals, kind of the why of the buy, I guess, when it comes to investing as well. And also the idea that it's, time in the market, not trying to time the market, and understanding it's a long-term process, and to just basically be patient, and then also looking at how we can start with baby steps and how that is kind of enough sometimes if we feel like we don't have enough cash on hand to invest like we want to.
Absolutely. Yeah, learned a lot of great lessons there, Parween. So thank you very much. And lots of great takeaways there for our listeners. Also, go girl power. Woo. Thank you so much for joining us on the show.
No, thank you for having me. I think it was a great discussion. So hopefully your listeners all got some key takeaways.
Kadeem, what was your sort of biggest takeaway from that?
We have mentioned, net worth by 28 was 200,000, and that's also, without crypto, that was a very slow, balanced approach, which is very interesting to me. Because I think, typically you hear numbers like that. That's going to be basically the tease for a video on TikTok by someone who's telling you about, the latest NFT or whatever. So there's an interesting take from someone who's more of a accredited financial counselor, and also took her slow approach, mostly focusing, on robo advisors.
Mm-hmm. One thing that she said that stood out to me was she was talking about some clients and how they were investing in individual stocks. So, I bought stock X, I bought stock Y. I think that's the scary point that puts off a lot of beginners. Myself, certainly, if I were to go into a sort of online brokerage and just try and pick one, sure, I could do it. I'll read the information sheet as she said, but you just can't guarantee when you put all your eggs in one basket that that's going to be a good choice for you. That would be an aggressive move, in my opinion.
100%. Because I was thinking she mentioned that client thought that would do well. Maybe that client was trying to look up, news on new products and different business reports and so forth. But it seems like, there are things that can happen with that out of your control.
Mm-hmm.
I mean, we look at COVID as a whole for the thing that affects your investments.
Yeah, well, exactly. I actually have a friend who sold their Tesla stock during COVID because there was all of the issues with the car industry, supply chain disruptions, shortage of chips, etc. And so everything was looking pretty gloomy. They sold their stocks, and then within a few months, everything was back to sort of record highs, and they sold at a loss. And it was we were talking in the garden, and it was one of those sort of, what have I done? But that's one of those short-term decisions that people make that then you talk to your friends about it, and that puts your friends off from investing in the stock market because they think, oh, well, Johnny just lost a load of money by making one bad decision. So it's interesting.
No, definitely. I feel like doing it properly when you're picking individual ones almost becomes a bit of a full-time job in itself. I feel like that's kind of, daily updating, kind of and checking in on the market and so forth. And I feel like that just can add a lot more stress, especially if you're already sort of tight with money and then you don't have as much you put away. Because we also touch on the point where any money you put there should basically be money that you're okay losing. And that's kind of like the old advice, I think, for gambling investing. But for some people, they might be trying to basically make more money off of it, putting away stuff that they should not be investing in the first place. And then that adds more stress to it as well.
Mm-hmm. But the idea of losing money is always horrible.
Oh, definitely.
Well, I would say that I'm quite cautious. It was interesting what she was saying about picking your risk tolerance and how she started off as quite a cautious investor as well. I do wish I'd been a bit more aggressive in the early days. But I also agree with what she said about kind of learning, getting into your comfort zone, just being more educated about what you're doing will kind of increase that confidence and enable you to make more aggressive decisions with potentially more likely a better outcome. Yeah.
I would agree with that too. And I think a big piece for me was just starting earlier. I think that just motivates me to keep taking the baby steps and not be discouraged that I can't do more at the moment.
If you like this episode, be sure to subscribe, rate and review us on Apple, Spotify, or wherever you're listening to this podcast. If you want to get in touch with us, you can email us at hello@halfbank.com.
Special thanks to executive producer Samantha Eamon and producers Kevin Hamilton, Shane Murphy, James Battiston, and technical producers Marie Alkaber and Mohammed Tabish. This episode was edited by Lead Podcasting. Until next time.